Hey guys, thanks so much for coming by and watching this video. My name is Jeff. This is Jeff Talks Stocks, and today I want to share with you a few ideas that I read about. I was watching a YouTube video, and in the comment section there were a couple of great questions and they went unanswered, and I just thought, you know what, I'm going to make a video, I'm going to answer those questions, and that way the next person who wants to know how do I get started and need some really great advice if you're beginning in investing, you'll have an idea. You're going to have in your head a couple of really solid ideas. So let's get started. Now, the first question that I came across in the comment section was, I'm 20, almost 21-year-old from the Pacific Northwest in the US, and usually come to your channel about investing and general financial advice. I know a lot of my friends use Robinhood for their stocks, but I wanted to know how you felt about all these new investing apps you can download on your phone and whether they have some merit to successful saving and investing. You know, Robinhood is a new company, okay? They haven't been around that long, and it really is anybody's guess how solid and stable this company is going to be, okay? I have not personally downloaded it and started using it, even though it seems really exciting and kind of attractive. One of my questions is, what if I had a problem with my account? Maybe I bought some stocks and they didn't show up, or I wanted to sell some of them and I had a difficult problem with it. There's no phone number to call, and I just sometimes like to just be able to talk to somebody. And with apps like Robinhood or any of the investing apps you download, you just have to hope that if you send a message that you're going to get a reply and someone's going to help solve your problem. But you know, these are new companies. They don't often have customer service or very good customer service. So you just have to trust, and I just don't have a trust in a company that's 2 or 3 years old. There are brokers that are more established, like Vanguard, TD Ameritrade, Fidelity, E-Trade. There are a whole bunch of other ones. You know, these companies have been around for 30, 40, 50 years or more, and they have telephone numbers and they have people who work there and serve customers. So my view is, if you're investing for the long run, then you know, you want to invest with a company that's been around for a long time. I think if you're just thinking of starting out in investing and there's something stopping you from at least beginning, I don't see any problem with using Robinhood as a way to gain some experience. But for a long-term investor, I would definitely go with an established company. Also, here are just a couple of the questions I have about Robinhood. It's a new business. Will it remain the same? You know, it could be that once they get enough people using the platform, they're going to want to sell it to a larger company. There might be a big brokerage firm comes and offers them several $1 billion to buy Robinhood. Now all of a sudden it's owned by a different company, and they might decide to start charging for trades, and so then the whole platform kind of changes, and you have to decide, well, do I want to stick with it, or do I want to sell my holdings in Robinhood and transfer them somewhere else? So that's just something to keep in mind. But a larger concern of what happens to the app, or what happens as far as, you know, feeds for trading go, is this. If you can sell all your stocks just because something happens in the stock market, like it crashes or it goes down several hundred points in a day, you're going to be investing using human emotion, and it's just the worst thing. It's just, you'll be a disaster if you make decisions based on fear. And another thing is miscognition, which means you think you understand what's happening, you think you have an understanding, but you know, we're all able to fool ourselves, and sometimes we're susceptible to just fear or greed or just not understanding what's happening in the market. So what you want to do is take those short-term emotion and ideas out of the picture, because they will really derail you in your long-term investing goals, okay? So if you can remove feelings and fear and emotion from investing, you're going to be much better off in the long run, okay? And that's why I think having an account with a company that's established, where it's not as easy to just trade in and out from day to day, is going to protect you from yourself, and you're going to keep it really business-like, okay? So anyways, there you have it. Nothing wrong with Robinhood. I think it's much better to at least start using Robinhood than to never invest or never get started. But if you're at the place where you have some money and you're looking to invest, you know, for the long term, I think it makes sense to look at some other options. And I want to share with you another question here. Now this person says, what would you recommend for investing in the long term on the stock market. I'm trying to build a retirement portfolio, but I feel a little lost on what stocks are better for long-term investing, what industries are better, what countries are better to invest in, what things do we need to be aware of. You know, I think it's really tempting to think, because most people on YouTube and elsewhere are really getting interested in stocks, like whether they should buy Tesla or Amazon or Facebook or Apple or whatever. And you know, you become kind of part of this mentality of, I need to choose a stock, or as you said, you know, in this question, different countries, different companies, different parts of the economy. What I think makes sense to do, especially if you're starting out, is not try to be a stock picker. That's something that you can do later on if you want to, but you know, you really need a lot of time. I would say 10, 15, 20 hours a week to read and to learn and to research if you're really going to be picking your own stocks. And a lot of people just, they don't want to spend that much time. They're not interested in turning this into like a week-long occupation or profession. So if that's the case, I'd follow Warren Buffett's advice. And somebody asked him what his advice is for investing. And he said, well, what he's told the trustees who are in charge of looking after his wife's money when he's gone, he just said, and I'll just read it to you. He said to put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I suggest Vanguard's. So that's from the smartest investor alive. And he just said, put it in an index fund, 90%, 10% in this cash, of the cash in a short-term government bond fund. And so, you know, he knows that his wife is not going to be wanting to stay on top of the stock market and different companies from day to day. That's not her interest. So for most investors, for most people, just doing the index fund makes a lot of sense. So for a long-term investor, which it sounds like the person who asked the question was, because they wrote, they feel a little lost on what stocks are better for long-term investing. So this is the type of fund that Buffett mentioned. It's the Vanguard 500 Index Fund. The ticker symbol for it is VFIAX, okay? And just to tell you what an index fund is, in case you don't know, it's like a basket, and it holds a whole bunch of different stocks. So you don't have to choose any one. So it will hold some shares of Microsoft, some shares of Apple, some shares of Nike, Disney, Netflix, Amazon. So you don't have to choose any specific stocks. It takes that whole stock picking thing out of the equation. And it's not run by an investment management team who uses their brains to try to figure out which stocks. The S&P 500 index just holds the 500 largest companies in the United States. There's also an ETF. So for example, if you were buying this and you wanted to buy it as an ETF, the ticker symbol for that is VOO. And they hold the exact same stocks. The only difference is the mutual fund, it sells at the end of the day. At the close of the market, there's a net asset value, and you buy it once, and that would be at the end of the day. On any particular day, you get the closing price. And then the ETF, it trades like a stock. So throughout the day, you can buy and sell it. So that tends to lend itself more to trading in and out of a fund. It makes it easier, but again, I don't think that's necessarily better if you're a long-term investor. The costs, the expenses are just about the same for both of those. And then I just listed the short-term government bond index fund because that was mentioned by Buffett. At Vanguard, it's VBISX, that's the ticker symbol, and it's also available as an ETF, VGSH. These here are to invest in the 500 largest companies, and I just wanted to give you another option just since you're learning here, and I think this would be useful. I know I'd want to know about it. Is rather than investing just in the 500 largest companies, you can actually buy a mutual fund which invests in all, like a representative sampling of all the stocks. So large companies, medium-sized companies, and small companies. And a fund that does that is called the Vanguard Total Stock Market Fund. I missed a K there. VTSMX. And this mutual fund is also available. It's the exact same stocks that you would be buying. as a ETF, and that's called VTI. So if you want to research this online, you could type in these tickers or just type in this title and go to Vanguard's website, or you just do a Google search, and you'll be able to learn and kind of see all the holdings in that fund. So this would make a lot of sense for somebody who wants to invest for the long term and doesn't want to spend a lot of time picking individual stocks, deciding on which sectors make the most sense, and trying to time which stocks to buy at different times of the year. It's very difficult, and again, human miscognition will lead you astray. Even though we all like to think we're smart and we're able to stay on top of everything, it's very, very difficult. So if you want to keep it simple, these are a couple of approaches that work. So here's a concept, and just what I want to say here is, the economy tends to work so that every 5 to 7 years, there's a stock market kind of a recession, okay? And the economy dips and the stock market usually goes with it. And now we're 11 years into it where the economy has not had a recession. We've been doing very well. But this drawing here, this picture, shows that the economic time you're in is a point on a curved line. So things go up and the economy does very well, and then it goes down. And if you just take emotion out of the picture and realize that this is reality, we've been going up and we've been doing well for a long, long time. We just have to understand that at some point things will go down. It's not that at some point the economy might go into a recession. It's just, it will happen. And when you can accept that things will go up and things will go down, the tide will come in, the tide will go out, you'll be better prepared emotionally and intellectually for these things happen. So whether we're here or here or here, nobody knows, but you want to be prepared for that. And as an investor, the best way to reduce your risk is just to invest at regular intervals, okay? Not all at once. So what does that mean? Well, you could set up an investment account, say with a brokerage firm. It could be Fidelity, it could be Vanguard. And you could just say, every month I want to put this much money into an index fund, and set it up, automate it, and then you don't have to think about it, and it just happens. And that way you don't put all of your money in at the top of the market, okay? Or try to pick a time, and you'll probably be wrong if you try to judge when the best time is. Another way to improve your chances of investing, no matter what you're doing, is just to read as much as you can so you can learn. And also keep it simple. If your strategy for investing is too complicated, has too many steps, or requires you to make too many decisions, you'll either never start, or you'll start and then you'll get frustrated and you'll stop. And none of these things work out well in the long term for an investor. Index funds are an excellent choice for most people. They're not necessarily made for everybody. If you want to spend a lot of time learning about investing, then picking individual stocks makes sense. But for most people, they're not interested in devoting all their time to learning about investing. So index funds make a lot of sense. I've written a book. I want to tell you about it. For anybody who wants to learn a simple and smart way to learn how to pick stocks, my book is called Stock Market Intelligence, and it goes through a very methodical system, a process where you ask yourself a series of 5 questions, and each one of these questions is about a stock you're thinking of investing in. And when you get to the end, you'll know whether this stock makes sense for you. Most of the time, you'll just say no, because the stock will not pass all 5 filters. But if it does, then that stock is probably a serious contender. It's available on paperback and Kindle on Amazon. And finally, thanks so much for watching this video. I appreciate you taking the time to learn, and I hope that this has taught you something, but I also hope that if you have any other questions, you'll just put them in the comment section below, because I will be checking and I will answer them. Remember, as an investor, you want to learn as much as you can. Don't never take any one person's advice on what to do, okay? You should take everything as part of your learning, including this video, okay? Also, I'm not a financial advisor, so don't take my advice as the last word in it. I totally recommend for anybody to seek out professional help if you want it and if you feel like you need it. But use this as something to help you improve in your learning and in your investing. And also, as a disclosure, I do own stock in Amazon and also in Berkshire Hathaway, since I mentioned both of them today. And thanks again so much for watching, and I'll see you in the next video.